So in today's video, we're going to be going over Wednesday's price action, October 15th. And the point of this review today is going to be to highlight how one could possibly frame a day using this philosophy or psychology, as you could say, for smart money, as ICT describes. So to start, we're going to be on the 1-day chart. And I'm going to go over just real quick the PDA raise that I used. You can ignore this box. This was just to cover up the price action after Wednesday. So we have this daily fair value gap that I marked on the gradient. And the only other level I have here is this, where shorts were framed for this short that we saw on that Friday. And I went over in previous videos why this short was used to frame the highs. And that was due to this being the swing high after we see it come lower. When we're expecting price to make an intermediate term or long-term high, and we're expecting that to happen after we take a swing high out, a previous swing high, your focus moves to what was the first candle to close above that swing high, and that was this one. And if we see this, right, in hindsight, then we know what, and not know, but it brings us to the question to ask, what was used here to frame this short? And, where were the shorts framed from? And that would be this closing price and above. The focus is on each closing price. That's an up close. And you could do this the same way going down, So like, say we have this swing low and we come and we take it out. Anybody that closes below this candle, you would be looking at that as a premium level once we come back to keep going lower. Or to keep going lower. So now that we have that out the way, let's drop to the 4-hour chart. And on here, I'm in RTH, and that's for the purpose of this opening range gap right here. We open, close, and then open here and go higher. So that's what that is for. Now, why am I just using this opening range gap over, per se, this one or this one? The reason that I'm using this one is because it's in between where the shorts were formed and where the main PD array that we're using this week is, right? So I want to grade the price action that's going to take place from here to here. That's going to give me an idea of relative strength, right? So now to begin framing smart money out, we're going to go back to ETH and we're going to look at Tuesday's price action. This line denotes when 6 p.m. for Wednesday price action begins, and all of this is Monday and Tuesday. So what have we done so far Monday and Tuesday? We had this really big premium range gap. We come back down on Tuesday to fill that gap, and a liquidity void that was made on I think it's visible on the 15-minute. We rally up. What are we rallying up for? Now, I've taught in my Discord that there's two reasons that we go up. We're either going up for buy-side delivery, or we're going up to accumulate more shorts for a sell-side delivery, right? And depending on the market environment and structure, you can kind of get a grand idea off the daily chart or a higher time frame in general what we should be seeing next based off what we've done, right? And what is the purpose for that to be done? What is that going to do for the market or for smart money or to retail speculators in a negative sense? So we observe here, we had this, and then we drop off, right? So what happened here? What happened here? So what happens here is we open up lower, right? A lot of retail speculators are going to say, okay, this is weak, so we want to sell here. So they get shit on all Monday. Monday was a bank holiday, but they get shit on, right? And then price drops. Now, where does price come before it drops? it comes to the consequent encroachment of that previous day's opening range gap from October 1st, right? So with that being seen, this is showing that above this level is going to be premium, or a deeper level of premium in relative to where this was formed. Because if this is going to be the point we use to go lower, then what does smart money look at this as? A reference point for premium prices. So looking at that same idea I showed you guys on the 1 day chart, where we go above the swing high, we look at the closing prices. I'll be carrying that idea forward, right? So we have this swing high right here, and if we were to take this out, where will we come to? It would be a level higher than 0.5, possibly here. And then after this is where you start looking for PD arrays. Now this one is, to me, the most simple and obvious to see, because it's right here, right? We kind of have this balanced price range, and then in this up leg that was what we would call used to frame shorts, we have the first fair value gap right there. So that's clean. That's exactly what smart money would be pulling to if we were to go short, right? And another thing that gives me this indication is this right here. Smart money used this to show relative strength in its final expansion up here before we fall off, right? So this would be expected to be used as an inversion if we were to revisit this level. So moving down to the 15-minute, and I'll throw on the trading sessions just so we can get a generalized idea here. So Monday's range, you can kind of see, was mostly consolidation. Tuesday's range made a high and grabbed premium and then delivers downward, right? And pay attention to where this premium was collected. It was collected in Asia. So all of this CBDR was compression, and then we expand through Asia and then reverse all throughout the entire day. And then thinking about AMD, right? If London is supposed to make the low of the day and then reverse and keep going higher, if it doesn't do that, when will it happen? In the next session. And we usually see New York sessions reverse on London's price action unless we're in already a protractionary stage with smart money. And what I mean by that is, we've already done work on a level. Say, for instance, we've already done work on this level, right? So now we can deliver from this level to a level of discount. You see here, each session is kind of stacked on each other. Like we have the London right on the low of the Asia, and then it's not as pronounced here, but it's still, you can kind of still see how it moves in the same direction. And the same thing here. We're in a protractionary stage to get back to premium. So looking at the Asia session, now that we have our daily psychology and philosophy around what smart money has done, now we can go and say, okay, what should we reach for moving forward today and Wednesday, hypothetically? So we see these soft tops right here in this unfinished business with this wick, and then we see right before we close, we see these soft tops made. So that tells me in Asia, if we compress, then this is immediately the target. Immediately. Why is that though? Why not focus on anything down here for imbalance, you know? Like we have this fair value gap and this fair value gap. What constitutes these two highs to trump this inefficiency? We've already had sell side delivery here from a compression state. We have compression, expansion, compression. That should be the next thing you expect, right? And then after that, you should see expansion again. So if we expanded lower and we compressed going higher, we should expand, not just off of this flow, not off of this workflow of oh, we compress, now we expand, now we compress. It's all based around the psychology and philosophy of smart money. If we expand, where are we expanding to? And once we expand there, what happens next? If it's a compression stage, what direction do we compress in? Where do we retrace to? Like, you have to think about things like that as well. And that's basically what this entire video is about. Things like that, where you're saying, okay, it makes sense if we're coming down here to see some sort of retracement up, right? And this is on a 15-minute chart. So when you go to your one, or when you were starting on your 1 day chart, and you already had the narrative that, okay, if we're going to come up, it's going to be possibly to frame shorts to go lower, right? So if that's the case, then we're going to be looking for shorts on the lower time frame. If we're not going to deliver shorts on the lower time frame, and that means we're going up. If we're going up, what are we going up for? To accumulate more short orders. So that's how you cut out indecision right there, right? Because you're looking on the higher time frame and you're thinking, well, it makes sense for us to go up to keep going lower, right? But it makes sense for us to keep going lower, right? But I see here we're going up. So it's like, I don't know which direction to pick here. I don't want to try to call a top. I don't want to be on a 5-minute or a 15-minute chart, like, yeah, this is the swing high for the day, right? And just trying to trade off of that, right? Because that's not really sound logic. So we're gonna zoom back in. Now that we have that philosophy that we should be going higher to accumulate the shorts, right? And then, like, you can also sit back and say, if smart money wants to go short, how can they hurt retail speculators? They're going to get them to chase price, then they're going to shit on them by taking out their stop, and then they're going to run. We see that here. They deliver price. More often than not, retail speculators are going to chase this, and then they get reversed on. Their stop gets taken out, possibly here. And then whatever stops are left above here, we see this London session rally, and then we see the New York continuation. And watch how we're using these quadrant levels, because this gives you a directional strength bias as well. Because if we're going to close on this quadrant level, and not many bodies, we have two, but not many bodies are closing above the quadrant levels, and then you see it kind of just poking right to that 0.5, and then dropping off. All this compression, right? So this tells me that we're possibly going to see a turtle soup scenario here. Now, you would, of course, need to have a level of inefficiency or reference to frame what would be buy side, for example. That would, in this case, be this fair value gap. Imagine this being a swing high. We swing the high and then fall off. So, looking at that, right, and then we come off, and then we start consolidating in Asia. Once London opens up, what I want to do is I want to observe how we are going to close above this high right here. And this is the exact same scenario we had on the daily chart, where I was telling you guys to pay attention to how we close above a swing high made, and then looking at the bodies that are closing through that swing high. And that can give you some, indication on, are we going to keep going a lot higher, or is this going to be a turtle soup scenario? And, when you see shit like this, when it just bings perfectly, that's something that I would look and say, okay, that's possibly a turtle soup scenario for me. So we see when we open up in London, and I'm going to go down to a 1-minute chart. So when we open up in London, now that 15-minute wick, we see this bitch just blows. So it doesn't really give you much of an opportunity to get in. And then you're looking at this, right? what time is this? 3 minutes before the macro. And what does it do? It uses the quadrant level of the daily fair value gap perfectly, right? And we just start climbing. We use 0.5. So think of it kind of like a ladder. Price is reaching for the next one, and then it uses it with its foot to go higher. It reaches for the next one, uses it with its foot to go higher. And we compress right here. This is all time distortion. And look at the time that it's occurring, right? 4 a.m. to 5 a.m. So that's the end of the London kill zone, and then it's the beginning of pre-market. So we have here at 5:01, we expand. That's inside the macro, and then we fall back, right? Look at how we barely missed this level right here. This is what the market is tipping its hand and showing you that we're likely to revisit this unfinished business. Because if we were going lower, it would have used that, or if it was going to go lower off of this reversal point, it would have banged that bitch perfectly. So that kind of gives you an indication that we may see price go longer. And then when we get here, we see New York opens. It uses the first quadrant level and the low, and then we drop off using the low of that. I believe this is the opening range gap, and we start to climb back up. Now, something you can do, right, and say now that we've extrapolated our theory of philosophy and all that good stuff down to the 15-minute chart, and you already know prices should be going higher to frame a short, and we have this right here. We obviously see what's happened on Wednesday, but say it's like right before that, and we're looking at London, and we're saying, okay, well, if we're gonna go long, and we've already taken this out. I'm about to show you guys some stars too. So we've already taken this out, and then we should be targeting these highs next, and somewhere above here, right? Either this fair value gap, one of these quadrant levels, or this old reference line. So when we see it fall off, and then we see, and I've marked out this price point because this was the old high, right? So this was the old premium reference. So now if we're going to go higher, it's going to turn into a discount reference. So go into the 1 minute chart, and without, like I was saying, if we already have our philosophy that we should be going up to go low, where would inside of London would we see a drop off, right? Because of course, if we're gonna go higher, we kind of want to hurt or retail speculators, right? So when we see something like this, these relative equal highs form, and then it drops off, that's exactly what you want to see. Now, you might not get the 930 impulse in the direction that you want, and a lot of people, that's what they want nowadays because it's the quickest way. But once you wait for, what is this, the 950 macro, 950 to 1010, that's usually when you're going to see a reversal and the initial expansion or impulse isn't in the direction of the day. This is usually what you'll see, a 10 a.m. reversal. 10 a.m. silver bullet crushes it every day that happens. So we fall off, we make these relative equal highs. We know as smart money speculators that this high is going to be taken, right? So if we're going to do that, we're looking at this drop like, okay, this is exactly where smart money is fueling in all these longs. This is where they fueling in all these longs. Now, specifically, where would the longs be fueled, right? And like I was saying earlier, we want to look at old swing lows or swing highs that are about to be taken and the closing points below that. So we got this right here. And I'm looking at down closes because we're about to go long. So these are 3 areas that you could have got in or started to look to frame a long out of, right? And that's not saying like as soon as this wick forms, you just buy on that, right? No. You stay patient. You wait for the macro, because even if it's 46, 47, 48, oh, let me use 45, right? 45, and you're saying, okay, well, I might miss it. It's 5 minutes to the macro and it's running. This is why you wait, because look at this drop. It shits on everyone. And look at all this compression from 9:30. Back and forth price action, back and forth. And then just like a switch at 9:50, things go back to business. And look at how we could have used this first wick right here. We see it wicks through, it closes, opens, drops. When it opens and drops and we're inside this zone, this is what you want. This is exactly what you want. And then look at how, and this is something else now. This is a array that I like to use. It's a variation of ICT's volume imbalance, right? But it's used to gauge relative strength. So when, for example, in this, we gap up, right? What I'm paying attention to is how long we stay below this this closing's price. And that's to say, are we going to close this in and go short and have a down close and just open higher, close lower, filling in that volume imbalance, or are we going to leave this open? Depending on how far, how fast, and how much time we spend below the closing price of the previous stick, that lets me know if we're going to leave that open or if we're going to close it, and what we're going to do from there, you know? So like, now that we have framed where we should be looking to frame our longs, you can also look over here and look for PD arrays, right? And look specifically for PD arrays that's on quadrant levels. And you see how like these quadrant levels are separated by around 40 handles. So something you can do is you can grade the quadrant levels. And this is based off of ICT's PD array matrix and how he taught that. He'll take a quadrant level and say, okay, this is equilibrium, this is discount, this is premium, inside the overall premium aspect or discount aspect of the entire range. So moving back over here, we can see how in between 0.5 and 0.25 we smack the consequent encroachment of that perfectly. And then even if you didn't use that, you still have this philosophy right here to show you that we should have been going long, or how to get in on the longs. And then moving forward, looking at this high, I want to see, and and now I don't necessarily use this high, right, to enter. Now we do have this high. This is what I want to look at to see if smart money is going to use it as a discount, or what it does once it gets below it. So the first time we visit, it was short-lived. Second time we visit, it was compression, and then we expand higher. The third time, we obviously know why this dug so deep, but just as a reference, I want to point out to you guys to look at closing prices and old highs and extend those forward in time and see how price action respects those old reference points by smart money. So now that we have all of this framed out, right? Now this is where you can begin to re-implement ICT's teachings. So observing this price action right before the move up, right? Because obviously we see here, once this move up begins, this was the only opportunity you had to get in, and you would have needed a market execution on that. You wouldn't have got tripped in on a limit. So where are we going to look, right? We're going to look for like things like first presented fair value gap. And where would that be? That would be right here. Now you could also have used 930's fair value gap, but that's not the first presented, only because it didn't happen after, and it's not the right criteria for it to be a 930 first presented. I believe the criteria is we have to take a RTH high and close above that for 930, the candlestick for 930 to be considered as the first presented. But we see here with this first presented, how price closes above it, opens, and drops into it. And where does it drop into it inside of that, though? The 0.75 level. So this is something Mike taught in his October 14th lecture. Any fair value gap that is inside, not any, but fair value gaps that are inside quadrant levels are high probability. It's just that simple. And where inside the fair value gap is going to put the quadrant level, that's why it's a high probability level. So moving forward, we see the delivery here. We climb through these, then we bounce off this 4-hour fair value gap that we all have outlined here, and then smart money reversal, and we start to sell back off. And look how we use these quadrant levels, guys. This is what I'm saying. Like, bow. And this is something Mike, oh, never mind. The line was throwing me off. But yeah, bro, like, we use the high here. We use the 0.25, and then we just expand through that. So this is now, to me, something I'd be like, okay, well, I want to look at this fair value gap. I'm not going to say, oh, it's high probability because it formed in the quadrant level, but I want to see how it's going to be used moving forward. So moving into, like, of course, we're not going to have much prevalent price action in these times, but I'm going to remove this box now. Oop, that was not what I wanted. So we're going to remove that box now and then stretch this forward and to Thursday and see how it was used. Consequent encroachment, it builds off of that. The high builds off of that. And of course it does, as we see here, come a little lower. Swing low right here. Price uses 0.5. Price uses 0.5 again. And then we frame the short. So today we had the same scenario play out. The exact same scenario as yesterday. Or I meant, yeah, as yesterday. We framed the shorts and then we fell off. Now we did take out the high and fill in this 4-hour fair value gap before falling off, that's cool. You know, if we want to get more precise and understand, and this is something I do when I first begin, I'll sit back and try to understand what was used to make the high, what are the prevalent price levels being used on the daily chart, whether that's a fair value gap, old high, you know, anything like that. Quadrant levels. Same thing I did earlier where I measured in between these, type shit like that. And, I mean, look at this, bro. Look how it uses the low. And look how old this fair value gap is. Bro, we're reaching all the way back from Wednesday at 1 p.m. And we're using that shit at 4 p.m. the next day. So it's great. And then now we're currently compressing. And we've made some expansions. So it's nice, bro. It's nice. But that'll do it for today. I appreciate anyone who's got to stick through to the end. This was how to frame a day using smart money's psychology/philosophy.